scrutiny. Workers at industries that have been heavily impacted, like restaurants, auto dealerships, and honestly, I had a loan that I was trying to do for a past client. We closed his home in Los Altos, and he was working for an auto dealership. And he came to me and said, you know what? I got this call from a lender to redo my loan and get this done. I really wanted to go with you, but I'm not going to because I'm probably a week away from losing my job. So, think about those issues when we go to close a loan. If that borrower has gone ahead and lost his job before we've sold that loan off our books, typically we can't sell that loan. So now we have a loan that probably is going to go into default. And I mean, it's just a mess. But so just to go in, hairdressers, because all the closeness, nail shops, non-essential businesses, all of those are difficult at this point, and we're obviously looking at those loans pretty hard.
Hey, Tom, just before you go on.
I'm sorry, Nick, go ahead.
I just have a question in the chat.
Yes.
You had mentioned a couple of things earlier with the restrictions on the different loan programs, and I'm sure that's where we're going to keep going. Do you mind just telling everybody if co-signers maybe help, or if this is also criteria goes for co-signers, just maybe clarity on that,
Yeah, co-signers are still okay. It depends on the loan program. And frankly, sometimes we see that even between a primary borrower and a spouse, sometimes it's not, we're dropping off a number of spouses because, they've got poor credit, and that's a big deal right now. If there's any kind of late payments, that's going to be a problem if it's within the last 12 months for sure. But then the credit score also has a lot to do with what we're looking at now. But so,
and I'm assuming too, Tom, that anyone who's receiving pandemic assistance right now, would that be a hit if you're reviewing? Maybe.
And I'll get to that because there's a
okay, sorry.
on that one too. Absolutely. But so, important items. I mean, as far as the file goes, very little has changed from the file as far as documentation, unless you're self-employed, which then we start looking a little bit deeper. But one of the biggest issues or changes is credit scores. We used to be able to go down to 620, and we still do, but with very little concern at the 620 level if we got an automated approval and things of that nature. With FHA, we used to go down to 580. We're now at the 620 range, depending on how the file looks. Supposedly, there are some lenders that are out there going under that 620 range, but it's I've got to guess that they're looking really hard at the file, and then as you get into, like we said, layers of risk, that becomes an issue. But self-employment, if there's low credit scores, if there's rental income, if there's gifts, depends on the LTV, debt to income ratio, the payment shock again, and first-time buyers, do they have reserves? And, one of the things that we look at also is their current mortgage in forbearance or any of their properties in forbearance, or have they missed any payments? And also a huge issue, we've seen people close their loans in the afternoon and then call us the next day and say, I want to go into forbearance. And that's a massive, massive issue for us as a lender. So now, if a borrower has any intent of, going into forbearance, the brakes are put on. And so loan officers, I was listening to a speaker yesterday, David Stevens. He's past, well, basically the head of HUD back in part of the Obama administration. And he was saying that there could be a situation where they change what's called LO comp rules. So loan officer compensation rules, where they could actually come back to a loan officer and basically do what's called a clawback. So, you know, let's say you close a loan and you told the borrower, close the loan. And when we close, then you can go into forbearance because of the CARES Act. Well, that will potentially then say, give us all the money back. Now, hasn't happened, but it was being discussed as a possibility to stop people from telling people, get the loan today and go into forbearance tomorrow. And I mean, I've even seen realtors tell people, buy a home now and you don't have payments for 12 months. So that's kind of a concern, obviously. Now, self-employed borrowers, definitely more intrusive. Once we get to a closing standpoint, you know, we've really looked at the loan pretty hard, but is that business still active and operating at pre-COVID income levels? So we, when we're underwriting, we'll ask for business bank statements to see, is that business still bringing in money? And Jennifer, this kind of gets back to your question of PPP. You know, we're definitely going to look at that because the business owner has to basically be in hardship, or at least be expecting it. And therefore, we've got to ask, hey, how's your business doing? And I just closed a transaction, back to its recording today, funded yesterday, where the buyer had 5 different businesses, real estate all over the state. What a nightmare. And one of the things that we had to do is look at pre-COVID bank deposits and, you know, all the way up to 10 days prior to close. How was that business doing? Were all the different businesses still making money at the previous levels? So then you get into the PPP. This particular borrower had said he was considering it a while back. And I said, you know what? Might be a problem, because then you're telling us maybe that you've got a problem. And his comment was, it's free money. Why wouldn't I take it? And he had so many businesses. I think he was saying that he could get up to like $75,000 or $100,000. And they're looking at it as a grant from the government, which, by the way, we all pay for, through those grants. And, it's definitely a big question mark. So we're looking really hard at self-employed borrowers.
Can I ask one quick question? And you might be getting to it in the future, so forgive me if you are. But when you refer to reserved in the previous slide, are you ever looking at what people have in like retirement accounts, like their own IRAs? Because I know with IRAs, you can pull money out early if it's used for real estate. Am I right on that? If it's used, there's something about that where you don't take as much of a hit. So are you looking at retirement accounts as well for reserves?
We are, but I mean, it depends. If it's market invested, typically we only take 70% of it.
Okay.
We also need the terms of withdrawal, because typically in the terms of withdrawal, it will say you can withdraw money, and it depends. There definitely are some, I think, like, I want to say 403Bs for teachers are pretty restricted. PERS, Public Employees Retirement System, or CalSTRS, California Teachers State Retirement. those I don't believe can be touched because they're basically sort of set up as an annuity for the teacher.
Right.
Yeah.
I was kind of thinking more for the self-employed people who have their own Roth IRAs and whatever. Yeah.
Yeah, but we do ask for terms of withdrawal. And, you know, some of the people are, you know, pretty unhappy with us. It's like, this isn't your business. And it's like, well, you're trying to borrow $700,000 from us. It is kind of our business. And unfortunately, given the environment, we do have to look at it. And it's not that we're trying to be, you know, really difficult. You know, when you look at the core of our business, you know, Fannie Mae, Freddie Mac, FHA, and VA, those loans are sold into security pools. And behind those loans, we're supposed to be doing all sorts of due diligence so that, you know, those loans perform to the guidelines of, you know, that particular program. So, you know, it's interesting. There was a lender that I think just got a $12 million fine. And you've heard of them. I'm not going to mention a name, but it's called the False Claims Act. Can you go tell me? Yeah. The False Claims Act is something where if we sell loans that we didn't follow the guidelines that the agencies tell us to, they come back to us and say, hey, you know, we could just remove your ability to do these loans, or you could pay for the losses and pay for some penalties because we've looked at those loans. So it's pretty interesting. And that's something that has stung a number of big lenders. And some of them have said, you know, we're getting out of the industry. We're tired of doing, some of them were insurance companies that were doing home loans. And, you know, one of them had to pay close to an $80 million fine. So, you know, that's kind of the consequence. But what we try to do is explain. And like, for instance, if you're taking down payment from a business account, one of the things that agency Fannie Freddie rules say is we have to look back at that business and make sure that we're not bankrupting the business, because now the borrower is taking all the reserves out of the business. And now, whoops, we've had a drop in income. The business failed. I can't make my payments because now the business is gone. So those are some things that I know this particular business owner was actually, he was real unhappy. And he says, why are you telling me where I can take money from? And I said, you know, it's basically Fannie Mae and Freddie Mac. What I always try to tell people is when you look at an underwriting guideline, I try to make them understand why we would be asking for something like this. But essentially, I always say, if Fannie Mae put it into their guidelines, it's because probably they've seen hundreds of loans that have defaulted because of this very question that now we're having to document. So there's reasons behind it. People don't like it, but statistically, when you have, I don't know, I think Fannie and Freddie have 60, 70, or probably about 60% of the home loans in the country outstanding. They've got a good reason and track record statistically of why loans default. But Jennifer, did this kind of answer your question?
Yeah, totally. Thank you so much.
Okay. So, you know, one of the big deals right now is also self-employed people and rental income. You know, think about all those landlords that have properties, and the landlord now has a tenant who's no longer paying them rent. They're trying to refinance, or they're trying to buy a new piece of property. One of the big deals is if credit scores are lower than, say, 660 on conventional, 680 on FHA, rental income, if it's greater than 30% of the qualifying income, we must either reduce the qualifying income by 25% as a buffer, or show 6 months of reserves in the bank. So there's a couple caveats here, but self-employed, same way. If credit scores are low, we have to reduce the qualifying income by 25% or show 6 months of reserves in the bank or retirement, whatever. So that's.
I'm sorry, are you seeing people coming with the self-employed who have all this? So are you seeing people do less down payment to make sure they have that in reserve? Like if it's an either or?
Yeah, that's definitely a good way to look at it too. Or you have a seller, if you're short for reserves, maybe ask a seller to pay closing costs. That might leave just enough left in the bank, thinking, let's say you've got $10,000 in closing costs. If the seller pays it all, that could be 2 to 3 months worth of reserves. So
that's great. Thank you.
Possibility, absolutely. And then age of documentation. One situation that we used to be able to do is future income loans. So your perfect example, a doctor that decides, okay, I'm going to move from the East Coast and I'm going to go to sunny California. And I got this job at UCLA, and I've got an offer letter. That used to be great. We didn't have to show receipt of that income. We do now. So unfortunately, future income loans are going to be put on hold until this whole thing is done. One of the things as far as aging of documentation, credit reports can't be older than 90 days. Income and asset documentation can't be older than 60 days. And then verbal verifications of employment down to 5 days from the note date. So we're calling the employer saying, hey, is this person still working? And, also for self-employed people, we're trying to make sure that the business is still active. When you get into the jumbo end of the market, there's actually lenders that are saying, places we sell the closed loans to that pool the loans, they're requiring that we call within 2 days of close. So, definitely looking at it a lot harder. Form changes. This is a big one. It's basically an attestation form that goes out with closing documents. And we're basically, making sure the borrower is attesting that they haven't lost their job. They don't know that they're going to lose their job. They're not going to get furloughed. They haven't taken on any additional debt. So basically this lower portion here in this slide right through here is the exact form. And it basically says, by signing below, I/we attest that since the date of my original loan application, the following apply. The status of our employment has not changed. All employment information stated on the original application remains true and accurate. And I have not received any notification from my employer indicating a change to our employment and our income status. Interesting, and this is horrible to even think it could have derailed this transaction. I've got a borrower doing a 1031 exchange. And, basically he's on a 3-legged stool with a noose around his neck of, you either perform on getting another property for your 1031 or you pay taxes. And so his wife, unfortunately, was furloughed. But thankfully, he made enough money, rental income was good enough that we didn't need to count his income. But there's all of these situations that are really, could have a severe impact. If you're coming out of a rental with a couple of $100,000 and you can't close a loan over the next 2 to 3 to 6 months because of this COVID thing, you could end up paying, 30% taxes on a couple $100,000, that hurts a lot.
Are you giving people, what's going on with 1031s right now? Do we have more time to close those? Like, have those been extended?
I was told that there was some leeway. I have not seen the exact detail on it. But I was told that, yes, there were some concessions made. What those are, I have no idea. But,
yeah, Jen, just so you know, Phil Atwan at Exchange Resources is amazing. So you can go ahead and reach out to him. He had an entire update on LinkedIn recently with the whole changes for the 1031 if you have questions.
What was the name again?
Phil Atwan. I'll put it in the chat.
Thank you.
perfect. Yeah, but so then, then the second portion of this number 2 down there says, we are not aware of any furlough or employment reductions in income or layoff. We are not suffering from financial hardship or any financial hardship which adversely impacts the information previously provided related to employment or income. And then number 3, we have not incurred any additional debt obligations, and all debt information stated on the application at closing remains true and accurate. So, the other thing that we're looking at is, has the borrower gone ahead and applied for any new loans that maybe aren't showing up on the credit report? That's always a question mark. So yeah, we're definitely looking at files a lot differently. Appraisals. I mean, here's the shining light on the hill right now. Those have been relaxed substantially. Property inspection waivers via automated underwriting, getting a lot of those. Traditional appraisals are available, so you do the full inspection, interior, exterior. Then there's also desktop appraisals, which aren't used as much as exterior only, where the appraiser just basically drives by, photographs the property, looks at comparables, and so forth. So those options do vary depending on the kind of loan to values, and other specifics in the file. But, definitely we're seeing some great stuff. Turn times on appraisals are great. A lot of our appraisals are coming in higher than the list price or contract price. So that's definitely something that's, less of a worry, one less item to worry about in our loan files. So, I mean, basically that's about it. Any questions or thoughts? I mean, hopefully I could go on and on and on in detail, but I don't want to, it's not an underwriting class, but I hope this kind of gives you a little scope of what's going on. Questions, thoughts?
I mean, for me, yeah, it's like I'm listening to this, I'm going, man, because for first-time home buyers, for people who still have jobs, like I have a couple of clients who have been working through this. They're essential workers, and but they've had no time to look for property now because of that. But I guess I feel like a lot of people who might have qualified now aren't, and I don't even know what my point is. I mean, it's like taking this in is very, humbling. And it's almost like, how much do you share and how much do you just sort of wait and see what happens a month from now? Because it's changing so rapidly, all the time.
Agreed. And I totally agree with you there. One of the positives, I think, is that as the economy does go back, I mean, personally, we've seen a couple of instances where, yeah, the borrowers have been affected slightly, but the transaction's still closed. We dragged them through the knothole and then pushed them back through again. And, they don't like it, but it's like, look, that's our environment now. And so, there are some people, what we've tried to say on the broker tour, I know you've been on a couple times, Jennifer, is try to stay away from the hairy deals. And when I say hairy deals, I mean, low credit scores, no down payment. They had a foreclosure 3 years ago or things of that nature. And foreclosure not necessarily is a problem if they've been through the waiting periods and have reestablished things and they've got, reserves. But it's definitely a different environment, and just trying to figure out, where this goes. I mean, personally, I think that, when you look back at that, one of the first slides that I showed, that it said that if you're making below $40,000 a year, 40% of those households have had job losses. I don't think that's our clientele, because in Southern California, you've got to be making $70,000 to $120,000 just to get into, the lower end of the market. And it's not unusual for us to see borrowers that are making 150 to 300 grand a year. And, frankly, I'm not thinking that this is super, super dire, frankly. I think we're going to get through this. I listen to a lot of speakers that have looked at it from an economic standpoint. One thing that I looked at the other day is they were talking about millennials, and they were talking about the number of people demographically that are coming through the home buying process potentially over the next, 2 to 5 years. And millennials supposedly are 3 times, I want to say it was 3 times bigger than baby boomers. Maybe I'm off on that statistic, but then they also said that if you have one child in that baby boomer era, that you are, that 82% of those people buy homes. That's substantial.
Yeah. I also think that they're the ones, the millennials, they're more comfortable buying. They're online all the time, so they're more comfortable looking at things online. They're more comfortable looking like virtual open houses, or more. I could be wrong, but I think it's like that's how I think they'll be finding their property, and also getting the virtual listing appointments and all that kind of stuff. Like, are you guys doing? You're clearly doing all of your work now virtually, right? So you're working with all your clients virtually.
Yeah, and we've been told by our corporate, you're closed down until May 31st, even if, the floodgates open, because they're concerned. They just don't want people getting COVID.
Right.
And, fortunately, literally, we didn't skip a beat, because prior to COVID, we had the privacy laws in California that really pushed hard to get, encryption done, all these other things. So corporate pulled everybody and basically said, here's a corporate laptop, and it's encrypted, it's VPN, it's, all this technology, dual authentication, email logins. It just goes on and on. That was a stroke of luck, because literally when COVID came, we were able to say, go home and work, and nothing stopped. We were closing refis in under 30 days with record volumes and no change in staffing. So it definitely, look, here we're talking over the computer. It's, who would have thought?
What are you seeing as far as the properties over, like the $1 million plus properties? What are you seeing in closing those right now? What are the typical loan processes?
That's a difficult one, because especially with the jumbo markets,
right?
Before this, so our parent company is Blackstone. That's kind of the mothership, and they were putting together all sorts of programs that was for that particular market. We had a 5% down to $1.5 million with no MI, and those loans were pulled back because they were definitely riskier. And, sadly, the banks are getting hit. So one of the major income streams for the banks, like your Chases, your Wells Fargo, your B of A, is mortgage servicing portfolios. So they may not originate the loan. They may take it in as, you know, a bulk purchase, or, you know, take it in via third-party originations, mortgage brokers. But they wanted the servicing income, because for every single loan, all they do is collect payments and then forward on the interest and taxes to the appropriate entity. But so they were making roughly, I think it was about 0.3% per year in servicing income. Well, now with that, nobody wants to buy servicing income, because the government said, hey, forbear, it's okay, it's no big deal. Now that lender, so a big bank like, let's say, Wells, I don't know how many billions of dollars they have sitting on their books that they're servicing. They now have to take out of their earnings and their reserves enough money to forward it on to the end investor where those mortgage securities are held. So your retirement plans probably have, if it's in a mutual fund, there's probably mortgage-backed securities in there. And so those servicers are now like, what the heck are we going to do? And that's why they've pulled back on the jumbo side. If they don't have a big servicing portfolio, they're not near as affected. And one of the things that, you know, as I was listening to this gentleman yesterday, Dave Stevens, who was the head of HUD, and then also president of the Mortgage Bankers Association, he said that he thinks jumbo is going to take a while to come back. You know, because a lot of the banks are sitting there saying, God, isn't this fun? We went through 2007, 2009. Now we're going through this again. And, you know, all of those banks took big, big baths on their loans. So, you know,
so basically you're going to have to just come in with a lot of money down. You're going to have a ton of cash to come in with, and then,
yep.
Okay, I got it. All right.
Until we see one more question. Yeah, until we see a rebound here with the economy where the investors feel comfortable to come back in. Like, truthfully, if they come up with a magic drug that, you know, is either a vaccine or something that will allow you to, you know, take 10 pills over a week's period of time and it's gone, you know, I think that that's the magic bullet, and then everybody goes back to the way they were, and the industry comes back hard, exactly, maybe not exactly, but pretty close to where it was. And then over time, you know, it's kind of interesting because, you know, I remember very vividly the 07, 09 through 2010 timeframes, and you know, we saw lenders starting to come back in with some really aggressive and, in my opinion, almost stupid programs where you could get a loan by showing a proof of income with one bank statement. And that was the ability to repay. And that just seemed crazy. Well, so all those people have backed out of that, you know, space now. And you know, will they come back in? I think it's going to be a while for the crazy stuff. But I think that, you know, it will come back. How it turns out exactly, who knows?
Hey, Tom. So Paul has one more question, then we got to go because Nicole and I have an 11 o'clock. As a listing agent, what would be your best advice for us to put in a multiple counteroffer regarding a buyer's loan? Any best words that we could use to protect our sellers?
I mean, find a good lender that you're really, really comfortable with and have them review the loan. You know, do the cross quals. I know people don't like to do that, but, you know, do it from the standpoint that you're protecting your seller. I'm doing a lot of those, you know, the selling agents, they have no clue what's going on. And, you know, so we do look at that to try and help people along. And, you know, for the most part, if you've got a seasoned loan officer that's been around and got a good reputation, you know, I'd feel pretty comfortable that they're paying attention. But, you know, you're going to have the people. I've got a transaction right now where the realtor is doing the home loan also. And in today's environment, I don't know how you can do both and stay up on your side of the business, which is changing, and our side of the business, which is changing. So.
Cool. Gosh, thank you guys so much for this information today. This has been awesome. I think that was really, really helpful, and especially for me too. So, anything else from anybody else? Nicole, do you have any last words or anything?
I don't have, sorry, I don't know if you guys can hear me. I got agents walking up and down all, so I'm trying to, you know, be the model with it on. No, I don't. I'm just glad that you know, helped kind of answer all these maybe questions, if not fears, or, you know, all this, we're hearing all this jumble talk. So I thank you guys for your time. I really appreciate it.
Well, and you know, realize that the government can't let the housing market collapse. I've heard a number of people say that the housing industry is what's going to, you know, maybe lead everybody out of this whole conundrum. So Fannie Mae, Freddie Mac, FHA, and VA are not going anywhere. I highly, highly, you know, doubt that's going to happen. The government backstopped those programs before, and I think they're going to, you know, there's still that commitment to do it now.
Yeah. Well, thank you guys for your time. I appreciate it.
Yeah, there's
You got anything?
thank yous in the chat. So,
Thank you. Thank you very much.
Thank you.
all right,
Thank you,
guys, have a great
everyone.
day.
Stay
Sounds
healthy.
good.
Take care.
Have a good day. Thanks, guys.
Bye-bye.
Bye.
Bye.